I would say don't bother with like individual stock picking. Get yourself a diversified index fund or index-based fund. Like most, like the GOAT, right? Warren Buffett, he says like the best investment for like 90% of people is just
Mm-hmm.
buying and hold a diversified index fund, right? The S&P, something like that,
Right.
either S&P 500 or the NASDAQ 100.
Mm-hmm.
And then even though these index funds gives you average returns, like over the long run, these average funds gives you above average results. Yeah, that's what I would say to them.
Very nice.
Yeah.
Your turn. Oh, all right. So hello, everybody. This is a collaboration between me, Convos with JJ, and Leon from Leon's Money Flow. So this podcast will basically this will be a first featuring podcast between myself and Leon. And it's really a casual sit down vibe on how our lives are doing. We'll talk a little bit about money, a little bit about everything, and really just anything in between to spark a good conversation. And recording just for curiosity's sakes, we're recording this at 8:50 p.m. Eastern Standard Time on Sunday. So just to give an audience a little insight that we're doing this on the side, and basically we're taking our weekend time to do this kind of stuff. So hopefully the audience likes this conversation. So before further ado, Leon, why don't you tell the audience a little bit about yourself in a couple of sentences?
Yeah, so my name is Leon. I run a channel called Leon's Money Flow. So I'm 25 and I've been investing since I was 20. So in 2020,
Mm-hmm.
and then I was doing traditional growth investing for like 5-ish years. And then a few months ago is when a few months ago I learned about like this cover call investing and like income investing, and I was like shocked at like all the amazing stories and returns that you can get from it. And like I decided to give it a shot. And then a few weeks later is when I fully shifted my portfolio to like these cover call ETFs. And then, yeah, the rest is history. And then
Mm-hmm.
I wanted to create this channel because I think this is a pretty niche topic,
For sure.
income investing. And so I just want to like create a channel to like share with others and let them see my financial journey, and hopefully people can start on their own.
For sure, for sure. That's a really great introduction. And shout out to actually your channel, because Jordan actually, I don't know if you actually watched his video that was posted today. He did a little basically shout out to most of the YouTubers that are featured in the income space. And he actually gave a shout out to you in
Yeah, I
that.
saw that. I
So
saw that. It was
it was
nice.
really cool. I saw
Yeah.
that. So yeah,
Yeah.
so a little introduction to myself for Leon's subscribers who don't know me. I'm JJ. Otherwise, my actual name is Jackson, and I am a 23-year-old investor. My handle on Blossom, I'm more active right now. I'm mostly more active on the Blossom social investing app. So at JJ Pandy, so JJPANDIE, where I am more active on that space. I am slowly transitioning to the YouTube platform, very slowly, because I'm doing this on the side while I focus mostly on school and my other side hustles, which are kind of like almost full-time businesses at this point. So I'm a 23-year-old investor, started investing when I was 18, basically in early, like late 2020 was when I was basically reading all about investing, mostly focused on the Canadian couch portfolio, which, if viewers are familiar with, is basically the sit back and just buy, all-in-one equity portfolio. So you have the one from iShare, the XEQT portfolio, the one from Vanguard, VEQT, and then there was also the one from BMO, ZEQT. I'm not too familiar whether ZEQT got released in 2020, but those top three were pretty much, neck and neck. You buy it, you set it and forget it, and then you basically dollar cost average into that. So that's kind of where I started back in 2020, reading a bunch of different investing books, YouTube Academy for sure. And then Beavis was actually the first YouTuber that I got experience to, binge through all of his beginner investing videos, and then moved to Adrian, also known as Canadian a T-shirt. He's very technical. His beginner series really helped kind of break down and break through those beginner questions I really had. Whereas like, oh, a lot of you don't need a lot of money to start investing. You just have to, I think the biggest things were to just create a brokerage account, know what you want to buy, and just start dollar cost averaging and basically putting money away consistently. So that part was really the biggest part of to really start and to really go and break through those, beginner questions, and that's basically actually get started investing. So my first stock, I actually did my first purchase ever after going through all of those beginner friendly videos, books, investing books, and the self help books, all of that. And while in 2020, because there was not much else to do really back then, because everything was on lockdown, so you couldn't really do much anyways. So I feel like a big mass majority of people really got into any sort of investing, any sort of trading activity, really during that period of between 2020 and
Yeah.
2022. Right? Because it was during lockdown. You couldn't really do much anyways. So a lot of it was spent either on investing / trading, you know, all of that in that section. And then you also have the online shopping. I wasn't really into online shopping. So that clearly went into the investing / trading area. So I bought my first ever stock. It wasn't XCQT. XCQT was my third holding ever. My first position was Coca-Cola because I really liked buying those dividend stocks, the dividend growth focus. So a small portion of my portfolio back in 2021, was Coca-Cola, and then you had Fortis, which most people in the Canadian space are very familiar with. It is one of two dividend dividend kings in Canada, which has consistently grown their dividend that pays quarterly every year for the last 50 years. So we had Coca-Cola, we had Fortis, and then we had Enbridge, which it's also a dividend aristocrat, not necessarily a dividend king, but back then it was consistently paying a dividend every year for the past 25 years. So also a dividend growth stock. And then the vast majority of my portfolio back then was XCQT. So I picked XCQT over the other ones because out of the three big so we had iShares, we had Vanguard, and we had BMO back then. Whereas for iShares, it had basically a 25% allocation to Canada, and then you had about a 48% allocation to the US, and then the rest of it was about less than 30% was focused on the emerging markets and the developed markets everywhere else around the world. So really like that allocation over 9,000 stocks. So yeah, so that's
Nice.
quite a lengthy introduction, definitely for Leon's subscribers and audience for sure.
That was good. Yeah.
Yeah. So I think to kick off this podcast, I think what we can do to have a really good conversation is to kind of play like 20 questions. So we go back and forth in questions, and if there's anything you want to add, we can really kick that off. So Leon, why don't you start with your first question?
Sure. Like,
Yes.
so you're a 23-year-old with
Hmm.
like you recently crossed the 7-figure portfolio.
That's right.
So I'm just curious on how like you got into your investing journey and how it all like started and looked like for you.
So I kind of briefly touched on that part, and you are correct. Even myself crossing that. So people on Blossom who basically follow me know that I recently crossed that 7-figure portfolio status, and a big portion of it is really using leverage and margin to help along the way. So when it comes to margin, you have to really be smart because you're not necessarily using your own money, but you are using other people's money to help grow your portfolio. And if you make the right and smart choices, then once you pay off that portion that you are borrowing, the rest of it you keep. And so that's why you kind of think of it as an alternative to real estate. Whereas when you think about it, people who buy into real estate, whether it's their first home, whether it's a real estate property, how do you how why do you think real estate market is so hot and people can earn so much in a given market? Well, it's not necessarily because they're putting all of their capital. They're borrowing effectively a 1 to 20 ratio, right?
Yeah.
You're putting 20% down or less and you're borrowing the rest of it, effectively a 1 to 5x. So that part is really, and you basically allow the markets to do whatever you want. You need to basically pick the right market. You want to time, because at one point you need to realize that pick basically buying into that whatever you want to purchase is the most crucial matter, because that depends what the value is of the real estate market. And so at one point when you sell it, you want to make sure that that value is much higher than what you originally paid for. So effectively, after paying off that mortgage balance, which is what you owe to the bank or to any other lender that you borrow from that real estate property, you effectively keep the rest. And so that's how people are able to successfully leverage other people's money and to keep the rest of the proceeds and continue that cycle. So effectively, keeping things short, I don't want to keep this answer too lengthy. I made lucky purchases because back then, I was very bullish on Nvidia and Bitcoin. Those were some, and then so Nvidia and Bitcoin were two holdings that I first initially started with, which, if you know, both Nvidia and Bitcoin really did really well. Unfortunately, I did not hold these positions in my TFSA because when I had my TFSA, it was more, diversified, because you hear horror stories where people don't make the right picks. They gamble on like meme stocks, on like weed stocks, on like whatever, and they don't do well. So that crucial contribution room is very sacred in Canada. That tax-free savings account contribution is very, you don't get much of it every year. So you really want to make good choices with that. So that's why with the TFSA, I really focus on like diversified position, XEQT, VFV, ZSP, QQQ, NASDAQ, all of that. Whereas I had a small kind of separate allocation in my non-registered account that was basically dedicated to both BTCC. So I had the Purpose Spot Bitcoin ETF, small portion in that. And then also NVIDIA, the NVIDIA stock, the NVIDIA, not the US version, US dollar version, but the CDR.
Yeah.
So I've held that for years, watched it compound and grow. And then effectively, once I fully transitioned to the PII, so the passive income investing style by Adriano, I fully transitioned. I knew about it in early 2023, but I didn't fully transition over until like 2024-ish. So I still had all of those holdings per se, part of my allocation, and then finally sold all of that off and transitioned over in 2024. So part of that was being lucky and being bullish, sorry, on those two picks specifically. But then the rest of it was really seeing that compounding of realized gains when transitioning from the growth to the income style. That kind of really did something to your brain. You know how when you're just growth investing, especially in 2021, 2022, when everything was super down, was super red, sure, mathematically speaking, you're supposed to keep buying, keep buying consistently, regardless of what the stock price is, and just, long term, it will go up. But psychologically, from a psychological perspective, because I was only investing about a year into it at that point, it was really hard to visualize the long-term effects. You don't really see it. You know it's supposed to be there, but it's really hard to grasp. Like everything is technically unrealized, so it's like everything is like on paper, right? Like none of it you actually are able to see are able to like grasp and to realize those gains and losses. So effectively, after transitioning slowly to the PII style, I saw that compounding, and at the same time, I saw my business take off. So I was like, okay, that basically gave me more motivation to keep investing. So I didn't, I guess, besides Nvidia and Bitcoin, which really helped my compounding growth along the way, it was the aspects of being lucky with those two picks, being consistent, and the switching mindset of putting more money away to reach that eventual fire goal, and seeing that monthly income basically surpassing my salary. And number three was using margins smartly. So I would say it's a combination of all those three factors.
Yeah,
Yeah,
and like now with income investing, you get to see the tangible results every
exactly.
month, right? So yeah, it helps with the motivation there and being
For sure, for
consistent.
sure. Yeah. So I don't know if you've noticed, but I just want to add on that. But like, there's this huge debate constantly on Blossom between the growth fanatics and the income investors. And there's always this huge debate between the two. What are your thoughts on basically this whole topic, this whole never ending battle that doesn't really seem to go anywhere, and it's not really benefiting anybody, especially beginners, because every day there's always beginners that are coming onto the Blossom social feed, and this sort of back and forth isn't really kind of benefiting anybody in this perspective. So what are your thoughts and perspectives on this constant debate, or whatever you want to call it, basically?
Yeah, I don't think it's very productive for a new
Hmm.
investor to see all this, but like what they should be getting is just like be in the markets and get an index fund. Like it doesn't matter if you're doing growth or income,
Hmm.
just do something and then be in the market and then slowly you'll have the compounding results, right? Like all the debate, as you said, it doesn't really go anywhere. But that I guess that's also part of the beauty of do it yourself investing.
Hmm.
Like you can choose what strategy works for you. If you like income, you go income. You if you like growth, you go growth. Or you can do a hybrid. You can do a mix of both, right?
Hmm.
So it's all up to you. And what I want new investors just to take out of this is you can just ignore all the debate, but just pick a strategy and run with it. Be consistent.
That's really sound advice. And so, what would be your number one advice? Like, if you had to pick out of everything, what would be one crucial advice you would give to just anybody on the platform, whether that be beginners, whether that be investors, just something in general?
Like, I would say don't bother with like individual stock picking. Get yourself a diversified index fund or index based fund. Like most, like the GOAT, right? Warren Buffett, he says like the best investment for like 90% of people is just
Hmm.
buy and hold a diversified index fund, right? Or the S&P, something like that,
Right.
either S&P 500 or the NASDAQ 100.
Hmm.
And then even though these index funds gives you average returns, like over the long run, these average funds gives you above average results. Yeah, that's what I would say do them.
Very nice. Your
Yeah.
turn.
Okay. My next question was like, so you're a full-time medical student too, right?
Yes.
And like you have multiple side hustles. Your consistency and hard work is like so inspiring. But like, how do you balance between all of these and like stay invested in the markets? Like, yeah, just how do you juggle them?
Man, you had to pick any question and you had to pick this question, huh? So just to basically, so my background is I'm not in medical school per se, but I am in the medical field, whereas I'm basically right now doing a doctorate. So, which is a PhD focused on infectious disease, if people are curious. So, really focused on refining and developing new vaccines that are able to basically counteract the effects of cancer. So that's one active part of my research, and the other part is because my principal investigator supervisor, which is the head of the research lab, so he basically had multiple collaborations, part of which is focused on parasites, and part of which is focused on pancreatic cancer and colorectal cancer. So those two. So we're really part of my research topic is I'm a second year doctoral student right now. So basically still in the beginning phase. So really figuring out all the different little details. I actually have one undergraduate bachelor's of science student who actually working under me, which is basically how I'm able to basically utilize my time. Probably not the best since it's not that, concentrated. You know how technically once you're working in research, you're supposed to be like always zoned in and focused on that topic for good or for good or for bad or whatever that saying is. And so that never really kind of vibed with my overall character of sorts. Like ever since 18, I'm always been like dabbling in different things. And so part of it was even though I was in school per se, I was basically, investing on the side, trading a little bit on the side, not that seriously, but always trading on the side. And then I basically started a landscaping company with a couple of friends. So we're also doing that on the side. So not a full-time thing, but also have something on the side. And I also had started a moving company on the side as well, since during that COVID area, moving was a big thing. So we also had that to worry about. So it was always I guess it's kind of in a sense where my brain works in a very different manner, where it's like I can't really get stuck with one thing. Like it always needs to be doing something. Like I don't know how you like to deal with routine, but I don't like routine. I don't like the repetitiveness of a routine per se. I like it when there's different things I can focus on every day. So it's not always the same thing. I basically, right now, I don't know, this answer is clearly not very structured, but really focused on one thing at a time and then build something else at the same time. But always keeping in mind the sense that n- no one income or job is sort of like stable. Nothing is really guaranteed. The one thing, like even a business, starting a business from scratch, like that during that startup phase, nothing is guaranteed. The one kind of guarantee, well, it's not really guarantee per se, but the one thing that you're more sure of its longevity would be investing. Because if you think about it, and I'm not talking about buying and dabbling into single stocks because that's like one fail safe technically. So if you kind of think about it, your job, that's also one fail safe. One business is one fail safe. And so when you're investing and you're diversified, you have multiple fail safes, especially if you go diversified, if you go broad exposure, no matter if you're going like the regular growth index fund, such as VFE, such as QQQ, such as VCN, which is VCN is the TSX 60, which is the top 60 companies in Canada, sort of like the S&P 500 of the US. Here in Canada, it's the TSX 60. So so you kind of realize that once you buy, and you don't have to really focus on one sector, you can have different sector exposures as well. You can have REIT exposure, you have energy exposure, you can have utility exposure, you can have bank financial exposure. You can also have like regional exposure as well in Canada, focus in Canada, focus in the US, focus in Thailand, focus in India, whatever you want to focus on. But all of those focuses, it really diversifies your risk. So you have multiple fail safes that you can rely on. So once realizing that, I always put investing first. Like I will always reinvest into my businesses, into these side hustles. But I've come to realize that investing is more guaranteed long term, especially if you do it properly, if you're diversified. Investing is more guaranteed of its long term success than these businesses. And so what I would do basically is the proceeds that I would get from these businesses, I would always do the minimum to reinvest back into the business. But then the rest of it, I keep like 10 to 20% just for like as a payout to myself that I can use to pay for school and all of that. But then the rest of it, the majority of it, goes to investments. So that's why I'm able to funnel in between these businesses, pay for school, and then pay for these investments, which basically ever since like 19 to 20, like it's basically captured, basically been investing over like 40%, 40 to 50% of my income. It's not normal, clearly. A normal person probably wouldn't do this, but it's just the way my brain is wired and how I guess part of it is really able to really be more financially aware than I guess the regular individual, especially in my peers. Because in my peers, like especially from school, especially from these businesses, they're technically, I don't want to say they're on a different stage. Not sure if that's the right word, but we're not they're not investing in the stock market. So it's really until you really get into the stock market and you're more aware, then there's always going to be a gap. Like whereas it feels as if I'm on this side of this gap, and then they're kind of sitting somewhere on that side of the gap. Not necessarily saying that it's a bad thing. I just want to put it as in that they are less aware of what is possible, and that you
Yeah.
don't necessarily need to follow that corporate grind, that corporate ladder if you don't want to. So yeah, that's
Yeah.
kind of what I wanted to say on that. Yeah.
That's a good answer.
Okay. So now I want to ask you, let's kind of put it a little bit back in terms of, I guess, in terms of the overall investing spectrum, where it's like, how did you transition? I guess let's start with, what did you first invest in? And then how did you transition to the income style? And did you also dabble in dividend growth stocks per se during that whole transitioning?
Yeah. So in the beginning, I mostly had VFV, so it was just an index fund. And then I had a few like single stocks
Mm-hmm.
from when I wasn't that aware of ETFs and how great they were. Um, so I had like Air Canada and another oil tanker stock or something, because back in 2020 there was this big hype of like oil stocks and oil tankers, and saying like, oh, oil's no one's using oil, and like maybe oil tanker stocks are gonna explode, right?
Mm-hmm.
I but um I didn't buy too much, but they're like way under than how much I got it for. So like I just kept it around since there's no use in selling right now. But like, yeah, so when I transitioned to income investing,
Mm-hmm.
I basically just realized the gains that I had from VFV. I had VFV and I had QQC.
Mm-hmm.
So VFV is S&P 500, QQC is NASDAQ. And then, so I had gains from that, so I just realized them, and then I bought QQC on USCL. Right?
Mm-hmm.
So those are like pretty much one to one. Well, not one to one, but like they're pretty similar. There's the same holdings. They're all both index based funds. And so I was pretty confident in just switching those over. And then I I didn't really have any dividend stocks before that. And so after I got USCL, QQCL, that's when I dabbled into like some of the higher yielding ones like HHIS and SDAY and QDAY now and stuff like that. But I don't, yeah, I don't really have any single stock ETFs. I only have, so I follow Adriano too, of course, and like he
Mhm.
has MST, and I also agree with his conviction and his idea about how MST is going to perform in the long term. So
Mhm.
I also have a bit of that, but outside of that, it's all like diversified funds. I don't like to hold any single stocks.
Okay, that's very nice. So let's talk about that transition more. Like from an emotional perspective, how long did it take you to basically grasp the income style? And then how long did it take you to basically do all those switches? And how sure of you that, because I think this is a big thing that most beginner investors per se that are more focused from the growth investing and then to slowly transition over to an investing style. How sure were you that it was gonna work? Like we technically per se, like we have Adriano as an example that he did it very easily, that he was able to basically grasp it just like that because of his past experience back, especially back in 2020, 2021, that he was already grasping with, closed end funds, REITs, uh, high, high paying dividend stocks, indicating space, and split share funds, all of those. So he was already basically transitioning slowly and grasping that after having paid off his mortgage and then basically chasing that higher yield and then slowly basically consolidating everything to what we know of his portfolio now, which pretty much is like 10 holdings, give or take. But then clearly what you watch on a YouTube video and then actually taking that step yourself. I guess this follow-up question is more for those beginners who have that basically fear of taking that step. So how sure of you of that conviction? And just tell me a little bit of that psychological transition.
Yeah, so I think the whole transition was about like 2 weeks. So it
2
wasn't
weeks?
that
Okay.
long.
Damn,
It
okay.
was like, yeah. So like I have how do you call it? It's like if I is it called addictive personality? Like if
Obsessive
I learn
personality?
about something, yeah, that
Obsessive
exactly.
personality, okay.
Yeah,
I have
once
the
I
same
learn
thing,
about
so
something, I want to learn everything about it and like
mhm,
focus all my energy into that one thing until I get like all like know a lot about it and like I can optimize and stuff like that. So when I watched Adriano's videos, his portfolio reveal, and then like watched all his previous videos. He had like 5, 6 years of content, right? And I like just joined, but I went back and watched all his videos. I like did some back testing myself and like I looked at the comparisons between VFV and like USCL, or like I take one cover call ETF and compare the total performance and returns with the like its growth alternative, right? And then
mhm, right.
um I saw like the math checks out and like
So you were
all
looking
the
at the
sorry?
so you were looking at the total returns?
Yeah, I like total return like the I was using like the ETF comparison tool and
Mhm,
whatnot, right? And then I saw like the differences are like are like fractions of a percent. And like so the performance is really small. Maybe it underperforms or overperforms by like 1 or 2%, 1%. But like in addition to like that, there's also like so many other benefits of income investing and like the psychological benefits and like the motivational benefits, tangible results as
mhm,
we
right.
alluded to in the beginning, right? And like so many yeah, there's so many other benefits of that. And so I feel like that the trade-off of 1% is like well worth the benefits of the income styled investing and like all the benefits from that and seeing like the monthly cash flow and like having that cash flow mindset now, especially for like newer investors or young people, they can be like, they now always know what to do with their money. If they have like some money, they can choose to spend $1,000 on the next video game console or something, or they can invest that $1,000 into a covered call ETF and get paid like 10, $20 for the rest of their lives, right? So
Yeah,
like,
for sure.
um, yeah, it teaches people to be like wiser or smarter with their
Build
money.
discipline. That's the
Yeah,
word, right?
gives them opens their eyes to like gives it to like all these options. Like they don't just need to buy this video game or stick to that 9 to 5 as you kind of mentioned before, and like
Mm-hmm.
you can like play with these cover call ETFs, and you can kind of like subsidize your salary from that, and like you can like you're no longer bounded by like making decisions just based on the financial cost. Like maybe you can spend more time with family or friends, or you can help take care of the people you love. Like and like I I think that Trump's far outweighs the returns of like the extra 1% or 2% that you can get from other styles and other styles of investing.
Yeah, makes a lot of sense.
Yeah. So for me, I also want to step back. I want to go back to when you talked about margin because I'm really intrigued about that.
Sure.
So yeah, like I wanna. Well, you kind of talked about how you approach margin. But like, how comfortable with margin are you now, and like, what percentage of like your available margin? I assume you're not using all of it because then what if you get
No.
margin fault, right?
Yeah, exactly.
And so, yeah, and also, like, do you see this as a short-term tool for just opportunities, or like it's just it's part of your long-term stretch?
I would say the way, okay, so let's basically take a step back and talk about what margin is. So, on the broad scale, don't want to go too technical. Essentially, margin or leveraging is you're effectively borrowing money from the broker and have access to much more money than, say, for example, that you're actually able to put in yourself. So, I've always known about margin from my parents who have basically real estate and investment properties. So I already know kind of like even as a young age of what margining or leveraging kind of means, and that you want to really take margin that you believe are safe, diversified, and like long-term holdings that you know with conviction that it will last a long time. So effectively, that basically eliminates single stock tickers on single stocks or ETFs on single holdings long term. Like if you want to trade like short term, then you may want to do like swing trading, but then you also need to be way more on top of everything that's happening on a global scale, just market news specifically, or even focused on the internal activities of that company in order to make sure that you do not lose your position. Because effectively, right now, at that point, you are not only risking your own money, but then you're also risking the broker's money. So you need to be 150% sure of you need to be 150% or even 200% convicted of whatever you want to buy if you want to play with single stocks or even like ETF, now cover call ETFs on these single stocks. So that's number one. So I've always known I guess the double edgedness that of playing with margin, that in a bull market you would basically get higher returns than than that one. So sometimes you would get 1.2x, you can get 1.3x, 1.5x, so on and so forth. But then on the downside, if the market is undergoing some kind of correction, or it's flat, or it's continuously going downwards during some kind of bear period, that leverage effect, instead of going only this, it's going to get magnified, which means that you need to be super aware and have a fail-safe when that happens, so you do not get margin called, which means that the broker either demands you to put more money into your account to basically maintain that ratio. So what happens is, let's say, for example, that you have $10,000 in a margin account and the broker puts up $10,000 as well. So effectively, you have that one-to-one ratio, then you have access to $20,000 and you buy $20,000 of whatever stock or ETF position that needs to maintain a 30% margin requirement, which means that the broker puts up about 70% of a position, you put up 30% of a position at $20,000. But then what happens during a bear correction and that position drops from $20,000 to, say for example, $13,000. So in that position, the broker, you have to keep in mind that the broker who put up that original $10,000 position, they will never lose their money. So in that $13,000 position, they still have that $10,000 guarantee, as you effectively went from $10,000 that you put up and it drops to $3,000. So in that position, now what you put up in that position is $3,000 of that $13,000 position. So right now, effectively, in basically, you're supposed to keep that 30% requirement of where you need to maintain at least 30% in whatever position that you have. And so in this specific example, let me pull out my calculator quickly. So you have $3,000 of that $13,000 position, and of that, you're at 20%. So you are now lower than that 30% requirement. So in this case, you are effectively in a margin call. We've seen that the broker requires you to you need to put in more money, and that you either need to put in more money within that specific period in order to reach and surpass that 30%, or if you don't comply, then they will sell that position. And so they keep their $10,000, whereas you effectively lost $7,000. So you're only left with $3,000 if that ever happens. So it's very important to keep in mind that either you think long term and you only buy diversified positions. So for me, before Wealthsimple released their margin accounts, so they had a beta period that was started in November of last year, which is when you had beta access to margin. So I clearly signed up and tested it out. But then prior to that, I was always very safe to margining. So this is actually taken influence and inspired by KYT, so Karyam Tom. So shout out to his channel. And so what he does is he only has one position, XEQT. So that position. And then so he also has a margin position where he borrows money with international brokers. So he's done that for a long time because clearly it's diversified. So technically, because it has over 9,000 holdings, so there's not too many fluctuations from a day-to-day period that will cause any sort of massive drop or raise. So based on that, so my experience was I've always had a separate margin account with international broker, a small position, and I would be basically, instead of XEQT, I didn't really, because my risk tolerance, since it's just me, I don't have dependents, so I'm young, so I have a higher risk tolerance. in case anything happens. And I usually always keep a large cash buffer somewhere else, sitting in a emergency fund, like technically you always should have an emergency fund before you start investing in any risky holdings, just to have a fail safe. So I always had that as a buffer. So I was like, okay. So instead of going ICQT, I would basically have a margined account that would never go past 50% in ZSP. So S&P 500, regular S&P 500. And so I had that, and then that slowly transitioned into bank and USCL once the cover call versions became available and were available on international broker. So because they technically, prior to Wealthsimple having that margin account, IBKR in Canada had the lowest borrowing rates compared to the big banks, compared to Questrade. Questrade's margin rates are like just as bad as the big banks. So don't open a margin account with them, because they charge very high rates. It's not worth it basically for whatever you're getting. So I had that, but then IBKR, so what they do is they charge pretty low borrowing rates, which is tiered. So the more investments that you have with them, the lower the margin rate, which effectively, if I remember correctly, every $100,000 tier, it drops by like 0.5% to like 1% difference, which is pretty good. But they do charge commissions every time you trade. So every time you buy, every time you sell, regardless of whatever you're buying single stocks, you're buying ETFs, you're buying CDRs, which are Canadian deposit receipts. So effectively, you're buying stocks of, you're effectively buying the Canadian versions of the US stocks. So whatever you want to think about. Or if you want to buy preferred shares, you want to buy split share funds, whatever, all of those, it's not commission free. So every time you buy something or sell something, they do charge commission. So I always had that separate account with them, and then really just manual dripped into that position, slowly and steadily. Always had that in the background. And so when Wealthsimple finally released a beta account, I initially was very intrigued, because you can borrow both in USD and you can buy in Canadian. So the Canadian versions are based on Bank of Canada prime rates, minus, depending on if you're a regular client, if you're a premium client, which means that you have at least $100,000 with Wealthsimple, and then you can be a generational client, which is you have more than $500,000 assets with Wealthsimple, either managed or either as a regular DIY trader. So there's 3 different tiers. With the regular rate, it's the prime rate plus 0.5%. With the premium rate, with the premium client status, you are at that prime rate. And you also have the generational rate, which is minus 0.5% off the prime rate. And then you can also borrow in USD. And so that's based on the Fed rate in the US. And then you also have to factor in any sort of conversions. So right now, the prime rate in Canada is 4.45%. The prime rate in the US is 7.1%-ish. It's between 7 to 7.25%, give or take. So there's that. Basically, started testing it out first with US holdings, the high yield US funds, and then went through the whole Liberation Day spike and drops. So didn't really think that was a good idea anymore. So, and then basically I still had those positions, but then I added more money into that margin account and really focused on Canadian positions. So my mindset, clearly everybody has a different way of treating margin. You can think short term by basically trading options on your own. You can buy protective puts. protective calls, cash secured puts, cash secured calls, or naked puts, naked calls. You can do all of that by borrowing money, or you can trade like single stock tickers. You can do all of that if you'd like, but then you are also putting in a higher risk because not only you're taking more money into account, you're also borrowing against the broker, which also does charge interest. So that's more short-term thinking, and a long-term thinking is you're marginalizing against, safer broad indices or index-like positions that are more diversified, and especially now with like access to better and more improved cover call ETFs, you effectively pay at least monthly distributions that slowly but surely pays down that capital borrowing cost every month. So you have that. And so for me, I have that position because I kind of treated it as an alternative to real estate where you get monthly cash flow every month that you can either pay down slowly your capital, or you can borrow more and have access to more cash and take basically opportunistic moves during market corrections or rebalancing. So yeah, so that's kind of a long-winded answer to your question.
It's good, and I think I heard it from you. You said it's like buying a rental property, and then your monthly cash flow is like paying off the mortgage for you, right?
Exactly.
Yeah, yeah. So I like that.
Effectively, that rental income, so that net cash flow is what you keep, that you can either invest into your property, which means you're buying more cover call ETFs or whatever else you want to buy. Doesn't have to be ETFs. It can be single stocks. It can be closed-end funds. It can be, regular index funds if you want. There's no limits. So you're basically building your arsenal. You're basically building building more capital per se with that money. Kind of think of it as either you're doing a renovation, so you're adding capital value to your investment, or when you add a new position, you're starting a new property somewhere else. So you're effectively diversifying your risk exposure and risk tolerance. Or the
Uh,
other is don't do anything with that money because it automatically goes towards your capital, which means you're effectively paying down your mortgage in quotation marks slowly every month. So there's that.
yeah,
Any
great.
other questions on that? Margin? Technically, margin is not a very difficult definition and way of investing. It's really like the technicality is very easy to, grasp. But then you have to be aware of all of the nuances of basically going down this route. You need to be aware of the advantages and the disadvantages, and just be mindful of every step of the way that you are technically adding more risk. But then if you do it properly and you're smart with what you're investing in, higher risk, technically higher reward too. So there's that.
Yeah, I actually, since hearing that you're using margin, and then
Mm-hmm.
Jordan, from Cover Call Investing, he's doing a
He's doing the
experiment
same thing,
where,
yeah.
yeah, he's using margin to
Mm-hmm.
amplify his income. So, like, I also did some research and recently started dabbling into using a little bit of margin, not too much,
Mm-hmm.
like a few thousand, to, yeah, buy some of these broad index funds like USCL and see how that goes.
Sorry, what was the second position? You said USCL and what else?
I have USCL, HHIS,
Mm-hmm.
and I think I have Biggie right now too.
You have
But
Biggie in there?
yeah,
So just keep in mind that, so when it comes to specifically focusing on the Wealthsimple margin account, when each broker has their own sort of nuances and circumstances and basically what they want to set as. in Canada, effectively, the lowest margin cost that I've seen is the 30% margin requirement. But then obviously that can go as high as 50%, 75%, or even 100%. 100% margin requirement means you're not borrowing any money from the broker. That broker will not give you any money. So you can kind of think of it as bets. Once it's 100% margin requirement, you can kind of think of it as, like single stocks, like super high volatility single stocks, meme stocks, penny stocks. Maybe not. So I think the ETFs on single stocks, the cover call ETFs on single stocks, the majority of them, excluding strategy, the majority of them, I think even Tesla, so the TSLY from Harvest, you have NVIDIA, you have Coinbase, you have all of those tickers from Harvest. I think they fall under the 50% margin requirement, which means that it's a one-to-one brokerage. Usually newer tickers, newer releases that are available on Wealthsimple, they usually start at a 50% margin requirement, and over time that will go down to 30%. So that is effectively the case with UTES. So the bank, the Evolve Utilities cover called Enhanced Fund, UTES, and then also the same case as HHIS. So what I've seen is that it took Wealthsimple probably half a year, basically, since HHIS and since UTES were released, all of them started at the 50% margin requirement. And then since basically a month ago, they dropped their margin requirement from 50% to 30%, effectively allowing you more access to margin that you're available to. So with regards to your USCL position, your HHIS position, they are at 30%. But since Biggie only got released a month ago, that's at 50%. So
Yeah,
just keep in mind that.
yeah. I heard that from Cover Call Investing on his videos too when he explained that. But yeah, that's a good reminder.
Mhm.
Yeah.
Let me ask, so what made you want to start margin basically now compared to before?
I guess the same as or similar idea to like how other people or how Cover Call Investing is doing it. He wants to amplify his monthly income.
Mhm.
So I want to see if I can fast track and get more monthly income and also compound like build my portfolio size with
Mhm.
margin.
Mhm.
So yeah, and so I'm starting out small and slow, just so as I build more confidence, then now up my position more with margin.
That makes sense. So effectively, let's say out of your entire portfolio position, are you comfortable sharing your overall portfolio size and how big that that margin position is compared to the rest of your portfolio?
Yeah, so my portfolio that's in cover call ETFs is like roughly it's roughly 70K.
Okay.
Like, and I just have a couple of thousand in margin right now, so
Mhm.
um it's it's way less than like 10%. It's like not even 5.
Okay. That's very good to know. And how many different accounts do you have right now? Do you have, I would say, assume like you just have a TFSA. Is that maxed out yet? And then I was assuming you also have an RRSP. Do you have also an FHSA for newer investors? That's the first home savings account.
Yeah, I have all accounts, so TFSA, RSP, FHSA. They're all maxed. Well, RSP, I think I have some room. Like when I'm reinvesting now, I'm just reinvesting in my non-registered right now.
Do you have a separate non-register account to your margin? So do you have two different accounts, or is your margin account now your main non-registered account?
Yeah, it's just one.
Okay.
Should I separate it?
I don't think that's really necessary.
Yeah.
I do have a separate non-registered account that I'm building for a case study. I'm supposed to start it. I will be documenting it, but it's all set up. I literally just have to film it. But effectively, I'm basically doing, I don't know if you're aware, but Paul Santori, he's doing a real world use, like a real world case study, where he's basically has a separate, I'd say, $50,000 or $60,000 position, and he's effectively pulling out $1,000 every month, just to prove to the naysayers that even though I'm withdrawing that $1,000 every month, that account is at least able to keep pace, to stay afloat, and maybe grow. So what I thought about doing is I actually had a poll done about a month ago, just to really kind of build like a real world case that different Blossom users can use, and basically you take note, take information with their own use cases. So what I did is I built a $35,000 non regular account that clearly will fluctuate with right now 5 different positions, and I'm basically showcasing a 8-month duration to take on the persona of someone either in their 20s, in their 30s, 50s, 60s, and the most popular vote would basically build that eighth month period and have realistic expenses that this investor would have, and averaged out between $150 to $500 a month that they can pull out consistently every month, and then see whether or not that account would be stable. So those withdrawals that will be made I'm not really withdrawing out of that account, but that's just going to be funneled to that margin account. So creating a withdrawal per se, and really document how stable these withdrawals are. So let's just say average out about $300 a month. That's effectively a 10% withdrawal. So just to document how stable that is. And then I'll be basically, once I officially film that first video and see how that goes, that will be month 1. And then we'll move on every month until we hit the 8-month period. And we document how well or how successful or how unsuccessful this case study is, and then do any readjustments if we need to, and then restart the 8-month case study with a brand new persona at a different age, and then so on and so forth. So it's kind of realistic to, I guess, the different age groups, whatever makes the most sense, and for investors to really build their own, take whatever is useful for them. And so right now in that account, it's 5 different positions, a 4-way split between HHIS, UTES, SDAY, and CDAY. So SDAY, for those who are not aware, it's the Hamilton Daymax position, 80% in the Hamilton SMVP, which is focused on U.S. dividend aristocrats, such as McDonald's, such as 3M, such as Procter & Gamble, Pepsi, Coca-Cola, Walmart, so on and so forth. So there's about 15 dividend payers, U.S. dividend payers in that position, plus a 20% option position on VOO. So they're riding at the money or very close at the, either in the money or at the money options, to get that basically approximate 17 to 18% distribution rate per year. And then the rest of the 80% is in that dividend growth position that's left as is, so no capping upside whatsoever. And then you have the CDAY position, which is the same thing. It's also a Hamilton Daymax ETF, but this time that 80%. So that 20% is still just still focused on writing options, which resets daily on the S&P 500, VOO, pretty standard. But then the other 80% is on, instead of the US dividend aristocrats, it's on Canadian dividend aristocrats. So you have the CMVP positions, which we're quite familiar with. We have Royal Bank, Scotiabank, we have TC Energy, we have Enbridge, Fortis, a couple of others mixed in there. So it's really a Canadian version of the US So that's kind of, I have a HHIS position in there to focus a bit, like kind of balance between income and growth. I have a UTES position, which is defensive, since utilities are always needed. So it's more defensive. We have CDAY, which is kind of work a bit more on the growth side. We have SDAY with complements, focus on the bit more for defensive picks. And then and then I have like a 5% position in MSTE, the strategy position, strategy enhanced position from Harvest, just kind of like as a yield booster of sorts. I'm not right now, based on the fact in the last 6 months, strategy has been pretty much on a downside, on a downhill. So I'm kind of reevaluating whether I really want to hold that position or I might just switch to something else like Biggie. Kind of like still reevaluating, but I'm not sure if I really want to take that loss because it is a capital loss of about 20% right now, give or take, factoring those distributions that have been collected so far. So I'm not sure if I want to take that loss, or I might just let it do its thing and reevaluate
Yeah.
reevaluate later once I reach zero. Yeah.
There's no rush, so you can just
Exactly.
sit back
I
and
haven't even started that case study yet. Like I'm not really, that money is kind of just sitting there specifically for that case study. So I might just leave that as it is. And yeah, I don't know. Do you have any thoughts on this case study that I'm eventually gonna start pretty soon? Yeah.
I think it's pretty cool. It's pretty cool, and I like your selection of funds. I don't hold any UTES right now in my portfolio, but I'm actually, yeah, I'm
You
considering
should
it.
add it. Ute is a pure defensive position, so you don't need it in your TFSA or RRSP because you don't really need defensive picks. They're not. They're like kind of think of it as TFSA and RSP. You're effectively, well, RSP specifically, you're not touching. Mostly just focus on growth for the long term.
Yeah,
Utilities doesn't really fit in there, so I
yeah,
only have utilities really in my margin account, which, because you're borrowing money, you kind of need to balance out between risk and defensive plays. So I have UTES in the margin account and this case study position because you also want a balance between risk and defensive trade-offs. So unless you want to put it, you could put it in your first home savings account because of that 15-year time limit that we have to keep it open, and you may want to use it towards your first home. So that kind of timeline is kind of skewed. So you kind of want to, maybe you want to mix in some defensive picks in your first home savings account, and you can kind of use it for that. But UTES is, I would say, is a really good selection, especially for the margin account, because you kind of want to balance out that risk exposure per se.
yeah, yeah. I like how it has like all Canadian utilities,
Hmm.
like big players. Does it have any no financials, right?
No, no
No.
financials. That's bank.
Yeah, yeah. Both my mom and my sister, I think they hold bank.
Oh
They
yeah.
have
So your whole family is involved in copper call ETFs now.
like I'm fully into it. They're just like dabbling into it. They don't have too much. They're like my sister might have like 20 stocks in total, but like yeah, so they're just playing around with it because they hear me make these videos and like they like know I'm doing like my research and due
Mm-hmm.
diligence.
Mm-hmm.
So so they just want to see and test the waters there.
Okay, that makes sense.
Yeah. I forgot. Is it my turn to ask?
Yes. Yeah.
Okay. So yeah, I I know that you're well, I looked at your portfolio and I know that you hold some US listed cover call ETFs. So I was just wondering what's your take on them compared to Canadian listed ones? And then like for someone like me who I'm only in Canadian listed ETFs right now,
Mm-hmm.
am I like missing out on anything there? And should I get into some US funds?
Short answer: no.
Yeah.
I'll elaborate on that answer, but effectively, one of the main reasons I even dabbled into the yield max and roundhill funds. I only have those right now in my margin account and RRSP. I also have some yield max holdings in my TFSA. So all of that is like, I really started it when I was basically, yield chasing, be like, oh my God, 50%, 60%, 70%, 80%, like distributions on single stock ETFs. That is crazy. You have it on Tesla, you have it on Coinbase, you have it on Strategy, you have it on Nvidia, all of those. So all of those picks that are like sprinkled in there were really bought earlier on when they first released. So I also have the yield max fund of funds, the all-in-one, which is YMAX, and then I also have YMAG, which is specifically focused on the Max 7. And then also have a little bit in Alti, so ULTY, which everybody should know what this is. It's like an ultra yielder, distribution rate's about 100%, but then NAV decline of like 80%. So effectively, you're kind of outperforming the S&P 500 in the past 6 months as they revise their perspectives and they're actually holding the underlying. So they're not doing synthetics anymore, but they are actually holding the underlying exposures. One big nuance of the ULTY strategy is that they are like the fund manager basically is unlimited to basically having exposure to some stocks that have super high implied volatility, inconsistent NAV stability. So that's why there's always that problem with Alti. So I only have it in my RSP because I knew for a fact that this is kind of like a gambling position because RSP, not really touching it for a very long time anyways. Well, in my case anyways. So for at least another 30, 35 years, possibly. So I only have a little bit sprinkled in Alti in my RSP. I also have blocks. So the Nicholas crypto fund, which writes put spreads on Bitcoin and Ethereum, and then also has a bunch of long exposure to Bitcoin miners. So you have Mara, you have Hut8, you have Strategy, you have Coinbase, you have Robinhood in there. So some of the Bitcoin miners and Bitcoin treasury companies. So effectively, you have blocks. That's also only in my RSP. So right now, I kind of have it structured RSP from how I did it previously. Everything is in USD. So because everything was already in USD, I'll probably leave it in US holdings because you also don't have that 15% withholding tax. So it kind of works out. But then once I add new money to my RSP, you're kind of really not missing out per se on the Canadian listings because total return wise, I would say once you have that 25 to 30% leverage in part of the fund, long term, especially if the underlying holdings are solid and have long-term track records, such as the Mag 10, like all of those tech exposure holdings that we're like familiar with, then long-term, those Canadian holdings, even in the .U versions, so the USD version, I would say they actually will perform better than the USD holdings, which are more aggressive in their cover call strategy. So they sacrifice more upside to get those higher distribution yields. So when it comes to yield max and roundhill, same thing, high yields, kind of inconsistent NAV, which you kind of realize is the case because once you surpass that 30% yield, especially in the fund that doesn't have inherent leverage, because most of these, they don't have any leverage, then you are sacrificing in the NAV to get those high distributions. You are taking part of that NAV. So from that perspective, especially if you want to play with these higher yielders in a non-RRSP, so any other account, whether that be your TFSA, whether that be your FHSA, whether that be an RESP, so the registered education savings plan, or a regular non-registered taxable account, all those always are going to have that 15% withholding tax deduction. And on ultra yielders, which already could be losing or underperforming from a total return perspective against their underlyings, or just against the S&P 500 or the QQQ, so the NASDAQ 100, once you lose that 15%, because that 15% is on the entire distribution, and that distribution is the majority, basically contributes at least half or the majority of their performance, well, you're going to lose more of it in those non-registered accounts. So I would say not really worth it because you don't really need it.
Yeah.
Having that exposure, it just creates more complexity. And I'm actually trying to trim those holdings eventually. You're not really. I know Perry, I know Paul, they like to dabble with those because they're technically retired. They might want to use those higher distributions because they're not really pulling in income from like an actual income source, like a job, like a business or whatever. So they might want to like play with those higher distributions. But for us, as a younger person, as a younger, Gen Z, Gen Alpha, do you want to call it, like in that younger group who are still more focused on accumulation, having that exposure to those ultra yielders from YieldMax, from Roundhill, from Defiance, from Granite Shares. Yeah, Granite Shares, the Yield Boost series. And then you also have the new weekly pay ETFs from Roundhill. That kind of is its own thing, which you can kind of treat of it as swing trades on single stock ETFs. It can get very complex. So I would say to keep things simple, you don't need it, basically.
Yeah.
I had it originally because I was basically playing around to see how it fit. And then right now, the majority of those holdings, not surprisingly, are negative total return wise. So the only reason I still have these positions, save for YMAX, and QDTE, which is the Roundhill 0DTE exposure to the NASDAQ 100, save for those three positions. I still have my Tesla position, TSLY from YieldMax, Alti position, ULTY, NVDY. Actually, no, that's actually that's fine total return wise. But then you have Coney, CONY, the Coinbase position, and then you have the strategy position, MSTY. Those four positions specifically are negative total return wise. So I still have them because they are still paying. But then as soon as I break even and reach house money status, effectively means you've broken even from your original investment cost. And it's basically paying you, it's starting to make you money every month, well, assuming that the NAV doesn't continue to decline. And then hopefully, maybe there's going to be a reverse split if the underlying keeps declining. So there's all of that. Once I finally break even, I'm going to get rid of these positions and we have the Biggie.U position and then the HHIS.U positions. So I will be basically consolidating into those positions. So I would say short answer version of what I just said, you don't need it. It just creates more complexity.
And then
Unless you really want to focus on this more long term, but we're all busy. Like we have lives outside of the stock market. We're not really focusing on the stock market every day, every week per se, kind of in and out, maybe on a weekly basis, on a bi-weekly basis. Playing with these exposures, if you really want to, just creates more complexity that you don't really need to, and it's not really benefiting you any more than what we already have on the Canadian side. So hopefully that clarifies
there's
it.
like added tax implications, I assume.
Exactly.
Currency risks stuff. It's just keep it simple and be consistent with the Canadian one, right?
Yeah, exactly.
Yeah.
So I am curious in the fact that let's actually step back a bit further because I kind of want to, before we wrap up this podcast, kind of want to limit it to about an hour and a half, give or take. So for these few remaining minutes, I kind of want to put a step back and just, 'cause there's one question where like, how did you, how did you get aware of investing? Like, does your family invest, or did you kind of learn it and dabble and exposure like on your own?
Yeah. So, my family only. So my mom traditionally has been in mutual funds for, I don't know, 20 years or something. But no one else in my family invests. Well, like back then, no one invested.
Mm-hmm.
But then in 2020, yeah, everyone was stuck at home and like, um, wanted to figure out ways how to make money. So, um, a lot of people started investing, and then that's when I started learning more about it. And also, that is when I did my internship at Manulife. I used to, there was another co-op there that I used to always talk about stocks with. He was really bullish on Tesla. He, so we would talk about that, and that's also when I started watching Brandon's videos, Beavis. And then, funny story, Brandon Beavis used to work at Manulife, I think as a fund manager, right? Or
Yeah,
something.
I think so. Yeah.
Yeah. And yeah, I actually told him that I blossomed fan. It was pretty funny. Um, so yeah, I started watching Brandon's videos. And he also watched Brandon's videos, so we would talk about that during our lunch breaks, and it was yeah, one of the best times and conversations that we've had. And then it was, yeah, so fun. And then so he's been doing investing for a while. So I started kind of just investing slowly into like these index funds and whatnot. But I did a lot of research to Brandon's channel and also some other channels that I can't really remember right now. But Brandon was the biggest one. Yeah.
Very nice. Very nice. Great to hear. So I would say before wrapping up, let's do one more question, and you go first.
All right. So I want to go into like your mindset
Hmm.
and your habit. So what's one habit or mindset that's been key to like building your portfolio like fast as a 23-year-old?
I would say the biggest thing is having that entrepreneurial mindset of never stop learning. Let's take for an example that even though like I don't spend too much time at home. Like I don't have a work from home business, so I'm always outside, either in the research laboratory, at school, on campus, or at a client's home, doing either landscaping, building furniture, or, moving. So during those off times where I don't have to necessarily use my brain to focus on the task per se, I would always use those times to either listen to YouTube, listen to podcasts, or listen to, yeah,
Audio.
both basically between Spotify and YouTube. So I don't really waste time listening to music. I don't know, like when you're listening to music, you're not really doing anything productive. I don't want to get flack for this, but when you're listening to music, you're kind of just enjoying it. Your brain is not really taking anything informational from that. So during those times
Yeah.
where I don't necessarily need to engage with anyone, I'm just in my own zone, in my own manner, I would spend most of the time listening to podcasts, watching YouTube, listening to YouTube videos, that every day I need to take something that I need to reflect on, something new that I've learned that I can either improve on myself, or improve in my business, or improve in the investment portfolio. because the learning journey never stops. Whether you're super wealthy or you're just starting from scratch, like you're starting from beginner. Every day, you're always taking something new that you can either apply in your own life, in your career, or even in your personal or social aspect. So every day, one single thing, new thing needs to be learned. So I guess having that mindset of that always adapting, always reevaluating, always optimizing something in my life, that really helped build that consistency of growth in different aspects.
That's good.
Yeah.
I like to listen to like audiobooks when
Hmm.
I'm walking around or something, but I still do listen to music mostly when I work out. So I think maybe I'll stop listening or try to dial it back, and then I'll have a seven-figure portfolio like
You'll get
you.
there very fast. Yeah. With my mentorship, clearly. But
Yeah,
yeah.
yeah, sure.
So one final question for you. Let's make it fun. So on what out of let's do a two-part question. Number one would be, out of everything that you know, doesn't have to be a cover call ETF per se, but what is your number one stock or ETF that you like the most and why? And number two would be, what new innovation that you would like to see for to be kind of released by fund managers? Like, what one new innovation that you haven't seen yet that you would like to be released at one point?
Those are really good questions. So for the first question about what is my favorite, would say right now is USCL, just because it's the most comparable, similar to VFE, and I really like VFE. And a lot of people really like VFE. It's like the most traded stock on Blossom, right? And yeah, like it just consistent returns. Everyone benchmarks against it. Like when people say, "Oh, I beat the market," or "Did you beat the market?" They all are comparing against VFE. So I think like it's a very good foundation and a staple that belongs in everybody's portfolio. So your second question, innovation, what type of,
It can be anything.
you mean like a new type of fund?
Could be. I'm keeping this open ended. Like, you can really say anything. Like, one new kind of cover. Let's just say one new cover call strategy, a new leverage, one new holding focus, or one new like put spread like strategy. It can be anything like that you haven't seen yet that you would like to be like you would like to get released at one point.
Man, that's hard. Cause, like now there's so many cover call ETFs, so many options.
Mm-hmm.
Back back when Adriano started, right? Like, he didn't really have that many options, and like I commend him on how he did it. As like now it's like so easy to start because we have so many options, and like we play with 25%. No, well, we start off with no leverage, and then we play with 25% leverage, and it's been really good. I really like that because we don't now people don't need to sacrifice growth when they're
Yeah,
transitioning
exactly.
from like a traditional growth stock to this leverage cover call fund. And now we're experimenting with higher leverages like in Big E, which is 33%. So I think what would be cool would be, so like I always had a liking for real estate, but I haven't really dabbled into it, even though like since now. So I think maybe a leverage play on real estate might be pretty cool to see.
Mm-hmm.
I don't really know how the whole workings of that will be, but just some way to get some exposure into that side of the market would be cool because it's a really huge market, the real estate industry. Um, yeah, I think that would be it.
Yeah, that's a very good answer. So I'll just follow up with my own favorite.
Yeah,
So I would say right now, in terms of innovation wise, I would definitely say QDay would be probably be my favorite. The runner up would be HHIS, because clearly, who doesn't love tech? Who doesn't love
yeah,
both a mixture of growth and income? But in terms of the strategy innovation itself, I would say QDay, the Hamilton ETF, focus on tech. So you have 80% exposure to the XLK ETF, which is focused on pure, which is a play on pure tech. So you have semiconductors, you have AI exposure, all of that, and then you have a 20% exposure on. So you have the uncapped potential of tech. So you have only the tech holdings within the NASDAQ 100, purely focused on growth, and then you have a 20% exposure to a daily reset options on QQQ. So you have a really nice balance between growth and income. So the growth side is purely uncapped, and then you have a little bit of income in there, and you can clearly see right now in the bull run of how well QDay is doing. I'm not 100% sure, but I think it is outperforming HHIS. So in terms of a pure tech exposure, QDay is doing very well. And then you can also add either HHIS or Biggie for that income complement. At exposure to non-tech labeled holdings such as Strategy, Coinbase, Palantir, Google, Microsoft, Moscow, all of those that are not labeled as tech, but you have that exposure regardless. So QDay is probably my number one favorite. I don't have it yet in my portfolio because of how high its cost is, but once it drops at one point, then I will definitely add it to my portfolio. And
yeah,
then to wrap up that part two of my question in terms of innovation, I haven't really seen any, if it would be possible, any either leveraged or cover call plus leverage exposure to, if it's possible, to like metals. So you have maybe silver, you have gold exposure technically, but like silver and other rare earth, which pretty much provides a like the building stones, the foundation of technology, of everything that is needed. Like what's in cell phones, you have copper, you have cobalt, you have silver as of some sort. And
mm,
so it's really a defensive position that could be very suited in any investor's portfolio. So if possible, maybe we'll see that in the future. So yeah,
yeah. That would be
yeah,
pretty cool to have. And like we have gold ones, and I'm pretty sure we'll have silver soon, sometime.
yeah. Especially since silver is hope is will go on that bull run soon
Yeah,
as well.
yeah. So I think that's a cool idea. Yeah,
Yeah.
that's great.
So any last thoughts you want to say before we wrap up this?
Last thoughts. Well, if you're not in the markets, just get into the markets when as soon as possible. Do it right now. Like, just get a broad index fund, and then slowly your money will just compound. And if you like say, oh, you don't have enough money, right? But like the if you start earlier, the less of your own money that you need put in, right? So it's like, I think I did the math. It's like $120 a week, like a 10% annual return will make you just over $1 million in 30 years. And I think
That's
that's
about
pretty
right.
achievable for the average person. But even if you just increase it by 10 years, so you're investing for 40 years, then you only need $45 a week. So it's just being consistent, starting now, and then yeah, your money will grow.
Sounds great. Very sound advice on the great Leon. So, all right, audience. So, as you can tell, this is a candid conversation between myself, JJ, and Leon. So we'll hopefully do this again, maybe on a recurring monthly basis. And next time, we'll probably do a more in-depth review on our portfolios and whatever else makes a good conversation. So once again, this is JJ and Leon. So hope you all enjoyed this long-form podcast, and we'll see you in the next one. Bye for now.
Thanks. See ya.